In 1967, White Motor Corporation, after owning Diamond T and REO for nearly a decade, consolidated the two struggling brands into a single division called Diamond REO, hoping to resurrect them as a heavyweight competitor. These weren't just any truck companies. Diamond T had hauled tanks across European battlefields. REO bore the name of automotive legend Ransom Olds. Together, they had once moved America's heaviest loads when no one else could. But by the mid-60s, both were bleeding market share to bigger, better-financed competitors. The merger creating Diamond REO was pitched as a way to rationalize two overlapping brands and keep them competitive, but it ultimately did little to change their long-term decline. Instead, it became their death sentence. The leadership refused to accept they were no longer an empire, and that refusal would destroy them both. Diamond T had earned its reputation during World War II when their heavy-duty trucks hauled artillery and equipment across Europe and the Pacific. The Diamond T 980 and 981 became famous as the tractor in the U.S. Army's 45-ton tank transporter system, built to drag the heaviest armor across the worst ground on Earth. These weren't pretty trucks, but they were unstoppable. The company specialized in heavy-haul markets, building trucks for construction companies, and specialized hauling contractors who needed machines that could work under extreme conditions. REO carried an even more prestigious legacy. Founded by Ransom E. Olds, the automotive pioneer who had created Oldsmobile, REO represented engineering excellence. REO built a reputation for tough commercial trucks, often powered by its Gold Comet engines, and earned loyal buyers who cared more about durability than sticker price. Their trucks dominated commercial markets, particularly in fire departments and municipal applications where reliability mattered more than initial cost. Both companies thrived during the post-war boom, but by the early 60s, larger manufacturers were crushing them. International Harvester, Mack, and White Motor Company expanded their heavy-duty offerings with better financing, broader dealer networks, and aggressive pricing. These giants spread development costs across far higher production volumes, which generally let them price more aggressively while still aiming to maintain acceptable margins. By the mid-60s, Diamond T's share had shrunk dramatically as buyers realized the big manufacturers could offer similar capability with better pricing and support. REO's heavy truck business was shrinking fast through the early 60s as larger networks and better financing pulled fleets away. Fleet buyers increasingly migrated to brands with nationwide support. Their proud names still commanded respect, but respect wasn't translating into the financial strength needed to survive. This was the moment they made their fatal mistake. The combination wasn't framed as survival, but as a return to power. They could have accepted reality and found smaller, profitable niches where they could survive and even thrive, but instead they chose dominance. Diamond REO incorporated with a strategy that revealed their fundamental delusion. Instead of consolidating around their strongest products, they attempted to maintain everything both companies had ever built. They tried to keep a presence in multiple weight classes and market segments at once, from medium-duty vocational trucks up through heavy-duty tractors for construction and long-haul work. This is where they stopped acting like specialists and started pretending they were an empire again. The decision to maintain broad product lines was pure arrogance. Management convinced themselves that scale alone would solve their competitive problems, ignoring the reality that their larger competitors had achieved scale through decades of growth and investment, not through combinations of weakened companies. Diamond REO's product catalog sprawled across everything from Class 6 medium-duty models to Class 8 heavy-haul tractors. The company maintained the Diamond T921 series for construction work, reworked former REO heavy-duty designs for highway applications, and introduced models like the Diamond REO C101 cabover to chase the same high-volume fleet buyers the major brands were locking up. Each product line required different engineering expertise, manufacturing processes, and market knowledge. Maintaining this diversity demanded resources they simply didn't possess. Their most telling gamble was trying to compete in the premium long-haul market with the Raider, a high-end Class 8 tractor, against brands like Kenworth and Peterbilt that already owned the owner-operator loyalty. Diamond REO invested heavily in developing these trucks to compete in markets where established players had overwhelming advantages in dealer support and customer financing. In medium-duty trucks, they faced International Harvester and Ford, who leveraged automotive production volumes to achieve cost advantages Diamond REO couldn't match. In heavy-duty vocational markets, Mack held a strong position, but the fiercest pressure was coming from the West. PACCAR's Kenworth and Peterbilt brands, along with Freightliner, were redefining the premium heavy-duty market with lightweight aluminum cabs and fiercely loyal owner-operators. Diamond REO's response was to compete head-to-head across every segment. They invested in new designs, expanded manufacturing capabilities, and attempted to build dealer networks that could support their entire range. These investments required capital they borrowed against sales projections that proved wildly optimistic. Diamond REO inherited a scattered manufacturing footprint and tried to run too many product lines through facilities that were never scaled like the industry giants. The company lacked the focused, high-volume production that competitors used to achieve manufacturing efficiencies, but the complexity of their operations created overhead costs that larger competitors avoided through more streamlined strategies. Building an effective dealer network required substantial investment in training, parts inventory, and service equipment. Diamond REO provided this support through credit arrangements that strained their cash flow. Many dealers struggled to achieve profitable sales volumes across their scattered product lines, creating ongoing financial pressure throughout the distribution network. Their marketing efforts reflected the same lack of focus that characterized their product strategy. They attempted to build brand recognition across multiple segments simultaneously, diluting their investments and confusing customers about their core strengths. Their advertising emphasized heritage and quality rather than specific competitive advantages that would give customers compelling reasons to choose Diamond REO over established alternatives. Pricing strategy revealed their fundamental weakness in the marketplace. They needed competitive pricing to win business from established competitors, but higher costs meant competitive pricing resulted in minimal profit margins. Management convinced themselves that higher volumes would eventually reduce unit costs and improve profitability, but the volumes never materialized at levels sufficient to justify their broad market strategy. In 1971, White Motor Corporation sold Diamond REO to private investor Francis Caphart. What had once been sheltered inside a major manufacturer was now on its own, smaller, thinner, and far more exposed to the brutal cycles of the heavy truck market. Diamond REO's empire fantasy demanded capital they couldn't generate from operations. The combined entity inherited modest cash reserves from both predecessor companies, but maintaining broad product lines while investing in development and expanded manufacturing required substantially more funding than they could produce internally. They chose debt over downsizing, borrowing against a future that required them to succeed where both companies had already been failing. The borrowing began with traditional bank loans secured by inventory and receivables. These credit facilities provided working capital for expanded production and dealer financing programs. Initial borrowing levels seemed reasonable given projected sales growth, but the projections proved consistently wrong as Diamond REO failed to gain meaningful market share against entrenched competitors. By 1970, debt had climbed sharply, and leverage was rising faster than sales, leaving the company exposed in a market that punishes weakness. When competitive pressures intensified, management faced a critical choice between scaling back their ambitions or increasing their financial leverage. They chose leverage, convincing themselves their products would find market acceptance if they could maintain competitive efforts long enough. The heavy truck market's volatility made their leveraged strategy extremely risky. Heavy truck sales fluctuated dramatically with economic conditions, construction activity, and freight demand, creating sudden drops in demand that could persist for months. Larger manufacturers weathered these downturns through diversified product lines and stronger balance sheets, but Diamond REO lacked these buffers while operating as if they didn't need them. Margins kept thinning, too thin for a capital-hungry business that lives and dies on cycles. Their diverse product lines prevented them from achieving manufacturing economies of scale, while smaller volumes meant higher per-unit development costs. Fixed costs remained high relative to sales volumes, creating a cost structure that generated minimal profits even during favorable market periods. Dependence on dealer financing created additional financial strain that quietly bled cash flow. Diamond REO provided credit to dealers for inventory purchases and customer financing, tying up substantial working capital in receivables that turned over slowly. When dealers struggled to sell trucks, they often requested extended payment terms or additional financing support, further straining Diamond REO's already tight cash position. Customer financing became increasingly important as competition intensified, but they lacked the captive finance companies that larger manufacturers used to access capital markets at favorable rates. This forced them to provide customer financing through their own resources or expensive third-party arrangements. Financial reports and industry observers were already raising questions about whether they could continue without a significant turnaround, but these concerns didn't trigger immediate action from lenders who remained hopeful that the heavy truck market would improve and restore Diamond REO's profitability. Management responded to these financial pressures by doubling down on their growth strategy, rather than addressing the underlying structural problems. They introduced new truck models, expanded into additional market segments, and increased their marketing investments. Each initiative required additional capital that the company borrowed against increasingly uncertain future cash flows. The warning signs were visible to anyone who understood heavy truck market dynamics. Diamond REO's market share remained stagnant despite their investments, while their financial leverage continued increasing. They were burning cash to maintain operations while their competitors strengthened their market positions through more focused strategies and superior financial resources. Suppliers tightened terms and demanded faster payment, another sign the industry could smell trouble. These changes increased working capital requirements and reduced operational flexibility, making it even more difficult to respond to market changes. Diamond REO found themselves trapped in a cycle where financial weakness created operational constraints that further undermined their competitive position. The 1973 oil embargo shattered Diamond REO's precarious financial structure with devastating speed. When Arab oil producers imposed their embargo in October 1973, crude oil prices quadrupled almost overnight, sending shockwaves through every sector of the American economy. The heavy truck market collapsed as customers postponed purchases and fleet operators struggled with dramatically higher fuel costs. Truck sales plunged in the months following the embargo as freight companies, construction firms, and other heavy truck users delayed equipment purchases indefinitely. The crisis hit Diamond REO's customer base particularly hard because heavy haul operations consumed enormous amounts of fuel, making the cost increases especially painful. Customers who had been considering new truck purchases suddenly focused on extending the life of existing equipment rather than investing in new vehicles. Their order backlog evaporated within weeks as customers canceled orders and dealers stopped placing new ones. Plans for the next year collapsed. Factories built for steady production suddenly went quiet. Management was forced to implement immediate production cuts and employee layoffs, but fixed costs continued while revenues disappeared. The credit markets that had sustained their operations tightened simultaneously with the collapse in truck demand. Banks became reluctant to extend additional credit to companies in cyclical industries, particularly those with already strained balance sheets. Loan covenants were soon tripped. Once the numbers broke, the banks stopped believing. Diamond REO's cash flow turned sharply negative as the company continued paying fixed costs and debt service while generating minimal revenue. Working capital that had been tied up in inventory and dealer financing became a liability as unsold trucks accumulated in factories and dealer lots. They started cutting prices hard, deep discounts that still couldn't restart demand in the collapsed market. The dealer network that they had worked so hard to build faced their own financial crises as truck sales disappeared. Many dealers had borrowed heavily to finance inventory and facilities, and the sudden loss of sales revenue threatened their survival. Diamond REO found itself unable to collect receivables from struggling dealers while simultaneously being pressured to provide additional financing support to keep the dealer network operational. Suppliers began demanding cash payments as Diamond REO's financial distress became apparent throughout the industry. Accounts payable that had stretched during better times now required immediate attention, but suppliers insisted on shorter payment terms or cash on delivery. This created additional working capital pressure at precisely the moment when cash generation had stopped and borrowing capacity was exhausted. Management attempted several desperate measures to preserve the company's viability. They negotiated with lenders for covenant waivers and additional credit facilities, but banks were unwilling to increase their exposure to a company in a collapsed market. They explored potential mergers or acquisitions, but no buyers emerged for a leveraged company in a distressed industry. The company's board of directors faced the inevitable reality that Diamond REO lacked the financial resources to survive the downturn. Unlike their larger competitors, who had diversified revenue streams and stronger balance sheets, they had no cushion against the market collapse. Their strategy of competing across broad market segments with borrowed money had left them completely vulnerable to exactly the kind of industry-wide crisis they now faced. By late 1974, cash was so tight they struggled to meet payroll, and thousands of workers were eventually cut loose. The board authorized management to explore bankruptcy protection as the only remaining option to preserve any value for creditors and stakeholders. Diamond REO, now operating as an independent company, filed for reorganization on December 6, 1974, ending its short and fragile attempt to survive without White's backing. The bankruptcy proceedings led to the sale of the company's plants, inventory, and rights to the name. Production at the original operation wound down soon after, and most of the remaining employees were eventually terminated. In liquidation, the assets sold for a fraction of what the merger promised, and rows of unsold trucks were dumped at fire sale prices. They weren't killed by the oil embargo. It simply revealed what their greed had already accomplished.